So I first of all want to tell you that I got all of this, almost all of this, from Chart School and from Alexander Elder's book, The New Trading for a Living. And the reason is that I got that from there is it was part of the CMT curriculum reading in order to get my CMT. Admittedly, I'm still on level 3. I don't know if I'm ever going to get past it with my schedule these days, but I found a lot of this information in the level 2 book, and there is more information in the level 1 book too, if you want to really get into this stuff. So I just wanted to let you know about that first and foremost, because Dr. Elder is a friend of my father's, and I think a lot of him, he is actually a psychologist, so a lot of what I'm going to discuss also includes some of the psychology that's involved in volume. All right, so I'm going to talk to you not only about the volume indicators, which I know everybody's interested in, but you really need to know a little bit more about volume. So I'm going to talk about the definition of it and the behavior, and then I'm going to go ahead and get into the indicators. And there are so many volume indicators. So I pretty much picked either my favorites or the ones I know that there are always questions about. I, of course, use OBV, and I'll be discussing the weaknesses and strengths of all of these as we go along. So let's get started with, what is actual volume? And I think I think everybody understands that it's a unit is, the number of shares or contracts traded. So each share is a unit. And the thing that we forget is that it requires somebody to sell a share, and then the other one buys the share. So there's two individuals involved here. So if you think about it this way, if we have a certain amount of volume for a day and it's on a price rise, well, half of that volume, half of those people are losers because they sold their share and then it went up. So that's something to keep in mind as well. And then it reflects the degree of financial and emotional involvement. And what I mean is that, it does kind of give you an idea of the pain level among the participants, or the euphoria, I suppose you could look at it on the other side of it as well. So let's discuss a little bit about the volume psychology. So the greater the volume, the more pain, because 50% are losers on either side. Think about that, right? So that's why volume is really not a measure of the price action. Obviously it's not price, but it doesn't tell you the level of value like price does. Volume just tells you the excitement or lack of going on. So the first thing I was going to talk about is a short squeeze. I think some of you have heard that. So basically the prices start to rise. The shorts are now giving up because obviously their position is starting to get more of a loser. So they buy to cover. Well, now the rally is going up. So more of those shorts give up and so on. So there you go. You end up with a rally out of the short squeeze. So those who think the market's going to go down obviously are going to short it up, and so they have to cover it if it starts going the wrong direction, and vice versa is true, really. A trend that moves on steady volume is likely to persist. So one of the things we talk about is volume leading price. So when volume starts to fall, that means your supply of losers is low. So you've already given them, they've already given in, the volume is now starting to dry up. So that's when you start to expect a trend reversal. Now, when the longs start to sell, prices start to decline, then more people get worried. We see this in the correction. It encourages more to leave, and then it just sort of continues to grow on that. So that's what we mean by volume leading price. The amount of volume and where it's going based on where price is going tells you a lot. But you look for volume to lead price. But of course, there's times when it does not. So volume spikes or bursts of a high volume, that tells you that the trend might likely be ending. You're getting you're in the middle of a decline and you get this burst of high volume, all this excitement. It's kind of an explosion, and so you basically find that the trend is gonna switch out. So that's one of the things you can look for. And when I say a spike, that means, you've had very steady volume and then all of a sudden it's earnings or whatever it is, and boom, the volume just goes crazy. And that will tell you, there's a good chance you're going to see a reversal on what happened. In downtrends, it's an explosion of fear. You've got all these people that, it's moving down and all of a sudden you get this spike, and that means people are even more fearful. So you might see a short-term emotional reversal from the smart money. High volume is typically about 25% above your average over 2 weeks, and low is typically 25% below average volume over 2 weeks. And the typical, I think that StockCharts uses a 200-day moving average on volume. So here's the important takeaways that I want to, as far as just volume in a sense of what it is. We're going to, again, we'll talk a little bit more, but high volume is what confirms a trend. So the spikes suggest a short-term trend reversal. So you might get a quick pullback on a spike to the upside. So that's what we're talking, a very short-term reversal. It doesn't mean the trend's going to completely end unless you start seeing that high volume continuing as prices maybe start going lower. Then again, it feeds on itself. So the market will set let's say the market sets a new low and then volume sets a new high. That's telling you that that bottom is likely to be tested. And this is where we start looking for those divergences. And that's the reason, because we want to know if there's a divergence, that's telling us something is going on that we should know about. Volume shrinks while the trend continues. That's time for it's ripe for reversal. There's less interest in that price rise, and then ultimately your buyers run out. You get that buying exhaustion, and then you're going to see it fall back. Let's also continue with some of these takeaways. Volume during reactions against the trend. And this is what I mean by a divergence. So if you have an uptrend and then it's punctuated by a decline and the volume picks up, and then you see the dip continue and then volume starts to dry up, that tells you that the bulls aren't leaving and your selling pressure is spent, and that's a buy signal. So if you're looking at an uptrend, okay, and it's punctuated by a decline, okay, and then volume starts to pick up, and the dip continues, and the volume maybe starts to dry up slowly, and then that's when you find out, okay, well, there's still bulls in here because the volume is drying up. So the selling pressure overall is that exhaustion has been cleared up. The selling pressure is spent, and that becomes a buy signal. Now, if you have a downtrend punctuated by a rally on high volume, then you know that you're starting to see that the weak bears are starting to drop out, and the volume starts to then shrink after you've done that. Then you're looking at a sell signal. So I'm going to show you some of this on a chart. I think it'll make more sense when you see it charted. So let's look at some of the volume indicators now that we know a little bit more about volume. And the first one I'm going to talk about is on balance volume. This one is my favorite, mainly because back in the olden days, before Excel, I was doing the running total of the volume using barons and a ruler to go through the, I think we were tracking just the Dow 30 at the time, but it still took at least like 15, 20 minutes, maybe 30 minutes, depending, to calculate it all on my on the counting paper that we had, my father and I. So it's a much easier calculation. So it's basically a running total of what's going on with volume. If you have an up day, you take all the volume from that day and you add it to your cumulative total. On a down day, you just subtract all of the volume. So price is really, like I was saying, price is the value of the consensus, but volume is the emotional intensity about what's going on with price. So that's what you use the on balance volume for. So you can see, you can start seeing those trends. All right, so let's look at the next one, this fine tunes the OBV. Okay, so the OBV is a simple, right? Add on all daily volume, subtract when you have a down day. Pretty simple. But what, and this is Mark Chaikin's design, by the way. He changed what, there was a formula back that was created by a man named, let's see if I have his name in here, Larry Williams in 1973. He came up with the idea of accumulation and distribution, but his formula was slightly different, and apparently it wasn't considered as good because we don't even have that indicator on the original accumulation distribution. We don't cover. And rather than confuse everybody, I won't go through that old formula. But there is, if you go back into the books, in fact, I found, Dr. Elder's book talks about Larry Williams' version, but he does get into the Chaikin money flow as well. And this is sort of the precursor to the Chaikin money flow. So if you understand this, you really will understand the Chaikin money flow, how it works. So we're fine-tuning the OBV. So rather than just take all of the volume for the day and subtract or add it, you're going to, just based on who won that day, now we're going to take a fraction of that volume, and then based on who did the best, the bulls or the bears, that's the volume that we're going to use, is that fraction of volume. So if it's positive, the ADL, the accumulation distribution, will be positive if you get a close in the upper half of the bar, if you want an OHLC bar, so the upper half, and the ADL is negative if the close is in the lower half. And this represents your buying pressure and your selling pressure. So here's the actual formula, and I think this will help, and I'm going to give you a more visual in just a moment. But you basically take the close minus the low, and then from that you take out the high minus the close, and then you divide all of that by the high minus the low, and then you multiply by the volume for the day. So as you can see, you're going to end up with only a fraction, and that gives you that intensity because then you can add that, multiply that volume. So now you're seeing how intense or what the accumulation is or what the distribution is going on. So that's why they, of course, call it the accumulation distribution line. So let's go look. And I'm going to annotate this because the annotations are being weird. All right, so let's look at this a little more clearly. Make this more readable. All right, so the accumulation distribution, right? So this is the close minus the low, and that's the first part. And then we subtract the high minus the close. And then from there, we divide it all by the high minus the low. So that gives you an idea of how that fraction comes up, and you can see how you get those that, for example, this was a negative day, right? There's your open and there's your close. So it was a negative day. So the bar is in the bottom, the close is at the bottom half. And so that means we know our ADL is going to be negative. Well, you can already tell that because, you're getting the close minus the low is a smaller number, obviously, than the high minus the low. So that'll make that negative, and then we divide it by the whole volume. So you're basically taking that fraction, that particular subtraction, the close minus the low, and then high minus the close. So you're taking these two. All right, and you're subtracting this from that. And again, that gives you your negative number, and then you divide it by the whole thing. Okay, so hopefully that makes that a little bit more clear. So now, hopefully you understand the accumulation. And so if you understand this, and I think hopefully I simplified it somewhat for you, then you're going to know the Chaikin money flow, because the Chaikin money flow is only the it's a moving average of the ADL, a 20-period moving average. So you take the 20-period sum of all those ADL values, and then you divide it by the 20-period sum of all the volume. And that's where you get your Chaikin money flow. So it's basically a 20-day moving average of the accumulation distribution line. All right, not too bad, not too hard. Force index, and this one was created by Dr. Alexander Elder. I don't use it, but I think it's a brilliant idea. Another way to look at volume. And what he wants to do is, he talks about the fact that volume, is a measure of that emotional involvement, the pain among the participants. And so what he wanted to do is somehow be able to visualize that. And so what he does is just takes the difference between the price closes from one day to the next, and then he multiplies it by the volume. So if it's a high volume day, of course, that force index value is going to go way up. And the opposite would be true, of course, if the volume is very low and you get that price change. So think about it. You may have a very small price change, but it comes with a lot of volume. That's telling you something. There's some interest here. There's something going on, and we need to look at it. What he recommends is rather than just using, one period, difference of the close multiplied by the volume, that can be really, and I'll show you, it's a little wacky, a lot of spikes. And so what he recommends is taking a 13-period EMA of that. And that's what the default is if you go to a chart and start adding it on there. So what's the psychology behind the force index? And I think you could use this psychology in terms of the Chaikin money flow as well in a lot of ways. So, because again, we're looking at divergences, and that's usually where the good information lies. So let's think of it this. So the force index reaches a new high, and I put parentheses, if it goes the other direction, the vice versa. So when the force index reaches a new high, that's confirming the uptrend, because you're in an uptrend, and the force index is moving to a new high. That's telling you that there's some intensity, there's some excitement, because those values, remember, are getting higher. So if you make a new high on the force index, that's confirming what's going on in the uptrend. So if you get a new force index peak, that again, like I said, the bulls are strong and the rally is going to continue. What you look for are the bearish divergence here. So the force index starts making lower tops, and then the price tops are still rising. So that's considered a bearish divergence. So your force index tops, declining tops lines, think that way. That's a way to look for whether you're looking at a divergence or a convergence, but that's for another workshop. So here we go. So you have your price highs are rising, boop, 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 and your force index tops are falling, boop, boop, boop. So that's a negative divergence. Now, one thing that he does talk about is in order to measure the tops for his indicator, the force index indicator, you need to have a reset. And Tom talks about this a lot. You need to have it reset, go through the zero line between those peaks or those bottoms. So you need to have that happen. So if you've got this force index and it's riding above the zero line and you get this peak and you don't measure these peaks. You don't measure until you get that drop below the line, and then it starts to peak again. So hopefully that makes some sense. And again, I know this is I'll be showing you the actual charts, and hopefully that will help with that. All right, so that's the bearish divergence. You're seeing these price highs moving higher, but the force index tops are falling. So you can tell that there's not as much energy behind that price move, okay? Now, if your force index reaches a new low and it's continuing lower, the downtrend is likely to continue. But you need to watch for the divergences. And a bullish divergence, you will look for price making new lows, but see the force index lows rising. So on the indicator, you're having rising bottoms, and on price, you're having rising tops. So when you look for these divergences, it can be confusing, and I am also I'm not going to say I do tend to not follow the rules exactly, but the idea is on the indicator you're looking for either the declining tops or rising bottoms. Remember, those are the only two lines you'd pay attention to if you drew a trend line. We don't look at rising tops for anything unless it's the top of a trend channel. So we're looking at the indicator, and we want to compare declining tops or rising bottoms, because again, those are the trend lines that matter. So you're looking at the indicator first for those, and then you compare the tops, what's going on in price, and the lows, or what's going on with price as far as the lows. So hopefully that's somewhat helpful. And again, I'll try and explain all of these on a chart so that it's a little bit more clear. So there's again, you have to have that reset when you're looking at the force index highs and lows to draw those lines, the trend lines. All right, so the volume by price overlay is very simple, and I will show it to you, but it delineates the amount of volume at each price level. And basically it's a histogram on the left side of the chart. And so it tells you at this price level, based on the histogram, how high was the volume at that price level. And what I like to use it for is mostly just to see support and resistance that may not be visible when I'm just looking at price tops and bottoms. So sometimes you get a really strong bottom on your chart, and it seems like it's sitting in the middle of nowhere. It doesn't seem to be on support or resistance at all. You kind of are like, why is this strong bounce occurring? And I can almost guarantee when you put up volume by price, you'll find that that histogram bar is one of the highest at that level. So I'll show you an example or two of that. And I would recommend as well, if you have any questions about what I was talking about, like I said, you can read the book by Alex Elder. You can check out the CMT curriculum. But the free way is to go to Chart School. We're going to look at indicators and overlays. And again, this is a great way to get to whatever it is. So here are your overlays. And again, I will show you an example of the volume by price. So accumulation distribution line. And so you can get all of the information. This is the calculation and how you come up with it. For some reason, to me, this looks a little more complicated than the one I put up. So it's up to you. You can use this. It's the same formula what I showed you earlier. And then it gives you some great examples, and then the actual spreadsheet for what's going on, and as well the interpretation. So for example, remember we were talking about the accumulation distribution versus the OBV. So I'm going to show you a chart that I put together. Let's get this here. Yeah, I don't know what's going on, but my annotations are getting kind of messed up here on this chart. I don't know if it's because it's such a small one, but we'll see. So let's look at Amazon. And I'm going to add, this will be a great way for you to see how to do this too on your own charts. All right, so I cleared all of my overlays. I'm not going to do the volume by price overlay yet. You have to wait. All right, so I'm going to move the OBV to the top. We're going to do accumulation distribution. And then we're going to do Chaikin money flow. And then we're going to take, let's see, what was the other? Force index. We'll look at the force index. There we go. All right, so, and again, notice that these are the, remember, 20 period moving average of the AD line, the ADL line. So that's, remember, I talked about that for Chaikin money flow, and that's the default. I don't know why that keeps going in like that. Okay. And then the force index, remember he recommends that 13 period EMA. And I did promise you I will show you a chart with both of them if I have some time, the 1 period and the 13 period. So let's update this. And I imagine there's a ton of questions in the question box. Be sure and put your email address in your little profile. You should see the next to your, at the top of the Slido window, you see in the very upper right-hand corner, just click on your first name letter, whatever it is that's showing up there, and then you can put your email address in your profile. Nobody will see it but us, and I will try and answer your questions offline in case I didn't get to them or there was some confusion. So let's look at the similarities and differences here. All right. So first of all, on balance volume, like I said, I like to use it. It's simple in my mind. I can visualize it very easily and quickly because I used it all the time. And it's really very similar, as you can see, to the accumulation distribution. But there are times where they will diverge. They won't work quite the same. I can see right here, I'm going to get my little annotation tool going here. Right away, I can see a divergence here. So you've got declining tops, right? Over here, you kind of have rising tops, mostly flat. What's happening to the tops during this time? We're seeing them go down, right? But the tops, so right here, if you're using accumulation distribution, this would be a bearish confirmation because the tops are moving lower on the accumulation distribution, but the tops on price and the tops on price are also moving lower. So that's considered I guess in this case, a bearish confirmation because everything's going lower and it's kind of proving the point. The problem is, of course, you come out with a rally. What happened with OBV? Well, interestingly, it actually had a positive divergence because we have the tops here are rising, but we're seeing the tops over here declining. So that's kind of a similarity. And as I said, we can look at lows during that period of time as well. And we both are in agreement as far as the OBV. All right, so what's going on with Chaikin money flow at this point in time? Well, we can see we're getting these peaks over here. Again, from what I understand with Chaikin money flow, you don't have to wait for that reset in order to connect those tops. If this were the force index, we couldn't connect these tops. We couldn't use these as far as our divergence because we didn't see a zero line cross here. So what we can do, so you look over here at the force index, and if we're connecting tops, for example, we can't connect this one with that one because we haven't had a reset in between. So you're looking for the reset. So we can compare this one to this one because we've had a reset or two in here. So let's see. Let's see what's going on here. We've got declining tops on the Elder Force Index. And we have what's going on with tops during this period of time. They're rising. That would be considered a negative divergence. Got declining tops, but rising price tops. So your expectation when you have this type of negative or bearish, I guess you could call divergence, you should start to expect a decline. And while it didn't occur right away, well, I guess if you wanted to get really into this here, it did come in pretty close, didn't it, to call this this correction or a decline in February as far as Amazon is concerned. So interesting stuff, I would say. In the case of the Chaikin money flow, I'm not so sure it told me what I was looking for as far as divergences here. The tops are pretty even here. So I guess you could say they're going down a little bit. So hopefully that gave you at least a visual of how these work. And I will just very quickly show you a chart with the two force index values on there, just so you can see the differences. I'm going to clear this. It's a little easier. And we're going to put the force index here. There's that 13 period one. And we're going to do a 1 period one, which is just that main calculation. All right. And we don't need the scooter. All right. So see, as you can see, it's really spiky. So if you're trying to determine the, tops, bottoms, divergences, this is kind of messy. And it would give you a lot of signal changes. It would be very confusing. So it's much better to smooth it out. I think Dr. Elder found a really good smoothing EMA. I like it. And as we can see, it's pretty good here. So let's see. And that's where we were seeing another. Let's look at a couple divergences, and then we'll pass it back to you, Tom, and we'll talk about what I know we're going to talk about. So what's happening from here to here? That would be declining tops, rising price tops. That's a negative divergence. Expectation is a decline. And I guess you could say over that time period, we got decline. Doesn't always work that well, but I think it's pretty useful. Here's one, rising bottoms, declining price bottoms. That's a positive divergence. So you should expect a rally off of that. And that's what we got. So that's the great use of volume and the volume indicators. I think it's an excellent indicator. I know somebody had asked me, well, how much is it your number one indicator, or what do you pay attention to more? I include volume in my analysis, but it's not my go-to. I have the OBV on there. If I'm prioritizing, it would be the PMO, the moving averages, the exponential moving averages is what I use. And then I look at my volume, and then I look at the scooter. So that's sort of my, I guess, priority of indicators. So hopefully this was helpful, and I really enjoyed putting it together. It was a great way for me to refresh my memory on this stuff. And like I said, for further reading, I would recommend you go check out, let's see here, back. Well, I don't have it in here, but I recommend you check out in the StockCharts bookstore. Go look for Dr. Elder's book. And if you really, like I said, if you really want a great complete look at technical analysis, these are great because they basically take all of the good parts of, say, Charlie Kirkpatrick's book, Dr. Elder's book, Perry Kaufman, Jeremy Duplessis for point and figure. So it combines all of those into one big book. So these are really helpful too. And if you really want to get into it, you can certainly go for a Chartered Market Technician's designation.